Hello, this is Peter. Today is July 4th, 9:30. I'm going to open up my YouTube channel. I'm going to share the link. Okay. So since the US market is closed today, I'm going to be talking about the Canadian market. Um, I'll choose some of the stocks that are good for long-term hold, as well as we're going to discuss what is actually moving the Canadian market versus the US market. Okay, so Canadian market, um, so Canadian market, this is from 22, so 2020 composite index. Going to download the fact sheet. Okay. So this is the Canadian market as of June 28th. Very recent, only about a week old. Da-da-da-da-da-da. So annualized return. So if you invest in the Canadian market for the last 10 years, you're looking at about 6% return every year if you invest in the equity portion. Okay. And for the year to date, roughly about 5.63%, which is very close to the 10-year overall. 2021, very strong returns. 2022, all negatives, but then 2023 came back. Mm, So what I'm looking for here is top 10 constitutes by index weight. Okay, so we have Canadian market. So top 10 holdings in the Canadian market is financials, Shopify, energy, industrials, and IT. Okay, now out of top 10 holdings, we have one, two, three, four. So four financials. So all the banks that are related to um, uh, the financials were on top 10. Okay. And then we have Shopify, and then we have CNQ, and we have Enbridge, and we have CP, CNR, CSU. And sector breakdown, our Canadian market is pretty much 30% financials, 18% energies. That means financials and energy constitute of almost 50%, almost 50%. And then we have industrials, we have materials. IT is only 8%. Okay. So Nasdaq could be running every single day and it's at all-time high, could go up very much. But if the IT is the main theme in the market, then Canadian market is not going to run. On the other hand, if financials and energy are the main theme of the year, then the Canadian market is going to run very hard. Okay, So we have utilities, consumer discretion, real estate, healthcare. Okay. We'll have Nasdaq futures. Okay, so that's that. So that's the Canadian market. So what we know is we want to look at financials and I think it was financials and energy. Yep, financials and energy. Yeah, financials and energy. So we want to focus on financials and energy. Okay. Okay, going back to our market volume, intraday, we have TD, that's pretty active. Yeah, TD. We have TC Energy, Corporation Holding Share, Beat Farm. No, 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 no. We don't want to go into, these penny stocks. Air Canada is there. Suncor Energy. Okay, so now going back to the Canadian market, we are noticing that the BNS, Bank of Nova Scotia, is moving. I don't know how much it'll be moving, but it was at resistance and it's moving up. It's moving very slowly, by the way. Okay. Now, if I look at Bank of Nova Scotia, I want to look at the last 3 months chart, 1 year chart, and 5 year chart. Okay. When I look at this chart, when I look at this chart, what I'm noticing is that for the last 2 years, it's pretty much flat. Yeah, it was moving from 53 to 68. That's about 10, $10 move. Yeah, $10 move up and down, the highest and lowest. But it's been moving pretty flat, sideways. And I would expect, because of the volume is not there, I would expect this to actually move around the same range because it's a 2 year trend. Okay, it's a 2 year trend. Now, I want to look at fundamentals of PNs. So Google is your best friend. Just to look up BNS financials, and I see the last 4 quarters. Okay, expected 8 billions per quarter. A little bit shy in 2023, 2024, 2024. They beat both of them. Now, January 2024, that's 6 months out. So that was January 2024. After beating the expectation, the stock was on the move. On April 2024, although the stock beat the expectation, uh, and the revenue was also bigger, the stocks dropped here. It dropped It went from $63 to $62. Now, we are at this mark, and it wants to trend up. How long will it take? I don't know. But it's trending up. And also, I'd like to share not only the BNS, but I want to share RY. So Royal Bank, although Royal Bank is in the same financial sector, the chart looks very different from BNS. It's at all-time high. Okay, that means Royal Bank is leading the financials, whereas BNS is actually lagging in the market. Okay, the major difference between the Bank of Nova Scotia and Royal Bank is not because Bank of Nova Scotia is smaller than Royal Bank. Yes, it's smaller, but you want to look at why it's been going down. The strategy of Bank of Nova Scotia has been a little bit different from Royal Bank. Bank of Nova Scotia expanded into Caribbeans in the south, okay? And they lost a lot of money by investing in the south. Not recently, but a few years ago, they shut down. But that explains the difference between Royal Bank and Scotiabank. Okay, and it's also reflected in the financials too. If you look at Royal Bank financials, it's consistently outperforming. Okay, earning per share 2.29, revenue 14 billion. Compare that with RY. So with RY, Royal Bank, revenue is almost double. Earning per share is almost double. Hence, the difference shown, hence the difference is shown on their stock prices. Okay. Now, some might say, hey, does that mean World Bank is overvalued and Bank of Nova Scotia is undervalued? Uh, you can say so, but the thing with the banking in Toronto is that most of the time when people are buying stocks, they don't just buy one banking stock because the banks they kind of um, do the same thing. Especially in here, everything is pretty stable. It's like one bank taking customers away from another bank or the other, but they're pretty stable that way. Okay, so now I want to look at TD. So our benchmark is Royal Bank, and TD actually does its business in the States as well. Okay. Now, if you look at TD, oh wow, what's going on here? The EPS revenue, the revenue itself is very close to Royal Bank, but earning per share is much lower. Their revenue is higher, but earning per share is lower. That means their margin is smaller than Royal Bank. Okay. And I think, well, I was looking at TD chart the other day, and I think if any bank is undervalued, it would be TD. The reason being is their revenue is getting very close and their EPS is smaller than Royal Bank. However, um, when things get when things are getting better, like if, the economy is getting better, it's really easy to increase the earning per share as well as the revenue. So if the revenue is high, that means TD could have more room to expand or increase the revenue compared to Royal Bank. But at the same time, um, Royal Bank might be at risk if some of the customers are looking, hey, you know what? Um, Royal Bank is charging this much, that much, like they're taking more money away from me, so I prefer to deal with a cheaper bank. Then everybody's going to flock into TD. Keep in mind that PE ratio is at 13. Um, TD recently got fined, not fined, but the amount is not set yet. But there was a money laundering scheme that have been related to the lawsuit. Okay. And because of that, that was June 5th. So because of that, TD stocks have been under fire. Let's look at Bank of Montreal. Again, very similar price action. P ratio is worse than TD. That means BMO is a little bit overvalued compared to TD. And let's look. Certainly, BMO had been losing its ground. Okay. Their earning per share, so their margin is pretty high compared to their revenue, but still, BMO is losing its ground. Look at all the estimates, and they missed. They missed everywhere. Net profit margin 25%. Okay, let's look at CIBC. CIBC, I have no hope for. I think they've been losing a lot of businesses. Okay, let's see. CIBC is just even smaller bank compared to BNS. Their revenue is smaller than Bank of Nova Scotia. The profit margin is higher, 30%. Okay. So in terms of banking sector, so National Bank, I don't even want to talk about this, but this is a really small bank compared to all the other ones. Their profit margin is higher. That means they're an expensive bank. They charge more. They charge more for whatever business you bring them, and that's how they're able to survive. Okay. So from the consumer's perspective, the best bank to deal with would be Scotiabank because its profit margin is the lowest, and TD as well. TD would be the best bank to deal with because their net profit margin is 23%. That's the cheapest bank. That's the cheapest bank that you can find in the market. And we kind of feel it, right? We kind of feel that TD, every time you go to the branch, TD is pretty cheap compared to whatever they charge in RBC or whatever they charge in CIBC, whatnot. Okay. Now, going back to the Canadian market, this is a cannabis stock. Uh, we want to look at all the banks. BMO, BMO, CIBC, TD. Oh, what happened here? Okay, I'm going to get rid of all the other ones and just put EMA. The reason why I'm only using EMA is because right now the bank stocks, the financials are considered to be non-growth stock. They're more stable. They're more stable stocks. Okay. What that means is that um, for banking, they pay dividends. So people are more interested in dividends and the stability of that rather than growth. And technically, 9 out of 10 times, dividend paying stocks are not performing during the high interest rate environment because when the interest rates are higher, then you don't want to put into dividend stocks because dividends are paying lesser than what is available in the market. Okay, so the dividend stocks tend to underperform during the high interest rate environment compared to lower interest rate environment. Okay, now looking into the future, so we had a rate cut of 0.25%. And if we expect that the interest rate will continue to come down, then it would make more sense for us to actually invest in the banks. It looks like BNS is an uptrend, but all the other ones are in downtrend. I'm going to play around with BMO and let's see. I see the spread of BMO, and the spread is too big. I don't think it's going to move anywhere below 116 today. It's a big resistance. Mm, looks like TD wants to curl down. Okay, but that's that. That's that. Royal Bank recently had a big run, about 70 cents. But that's what the bank stocks do. They rarely move. They rarely move too much. Okay, so that's that. Um, I would actually recommend buying. So if you were looking into what banking stocks to buy, I would actually recommend buying. So for now, okay, I would actually recommend BNS, TD, those bank stocks that have lower profit margin but high revenues, because they're going to look into increasing um, the earning per share once they feel like they have enough base to do it. Now, World Bank already has a big client base and they have good margin, but mm, I mean, I don't think World Bank can just go better, like they will do better and better compared to other banks forever. Okay, and if it does, then we have more risk with the Royal Bank than all the other banks, because all the other banks, their prices have been already suppressed. Look at this. Okay, so this is the 5-year chart. Royal Bank was the only one that was performing better compared to its peers. I'm not saying investing in Royal Bank would be a had been a better idea, because it had been. It was really good that RBC was the only one that was able to just continue its run. But knowing that the Canadian financial market cannot be like this forever, at one point all the other banks will probably profit, and when they do, they have more room to run. They have more room. Yeah, they have more rooms to run. Okay. Now, uh, 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 I'll look at. Okay, so that's TD, Bank of Nova Scotia, BMO, Royal Bank. Okay, so on the other hand, uh, so this, if you put one of these stocks in your portfolio, your average return from the dividends would be 5.344. Okay. On the other hand, if you choose HCAL, which is the dividend paying ETF, consists of the Canadian banks. Need to look at what's inside. It's holding, so it's a leveraged product, and it's holding Royal Bank, NA, CIBC, Bank of Montreal, Bank of Nova Scotia, TD. And mm, its performance is actually better than most of the stocks because since its inception in 2026, its return every year is 15.8%. Okay. And I don't know if you can see this, but it's actually doing better than the overall market. But at the same time, when it dipped, it didn't dip as much and it just continues its growth. And the gap between is close to 30% at this point. So if you are thinking of putting individual stocks into your portfolio, I think it's better to look for something like this, something that will give you higher yield and higher return, which is leveraged investments. Okay. This is good. So that's the financials. Let's look at energy. Mm, Let's look at. I would. Um, there's only one energy stock that I really like, which is Nvidia. I don't like Suncor, but I do like Nvidia. The reason why I like Nvidia is that their Nvidia's, not Nvidia, Enbridge, sorry. Enbridge is pretty much monopoly in the Canadian market. Like they're huge. TRP. Okay, so let me look at the financials for Enbridge. So their PE is roughly about 18.6%. Their dividend is 7.47. Wow, that's really high. And if I look at their financials, their net profit margin fluctuates. And their revenue has been dropping in 2023. I would assume that the economy had been really bad recently, and the natural gas prices have been going down for the last 1 year. So that was the peak, came down, came down, came down. So I'm looking at the oil prices and natural gas prices. The natural gas had been going down to the low of 1.58. Oh, that's really low. And then it peaked at 3. So that's like double. So natural gas is very volatile, could go up and down, up and down. So now it's at 2.3. Oil, oil prices are a little high. So this was COVID, so it went down to like 17 bucks, and now it's at 83. And historically, it's been very stable. Like it's been going up, down, up, down, up, down, but it's maintaining this line because of the high dividend yield. And it's very stable. The business itself is a monopoly. Like there's nobody that can challenge Enbridge. Um, the way I see is this. The way that people should play NVIDIA is they should buy and hold within this range. Okay. So if Enbridge reaches, let's say, roughly close to $60, they can sell. If it reaches roughly about $40, they can buy. Yeah, 60 and 40. 60 and 40. Just 7. 45. It's in I think it's an uptrend. So anywhere between, so this one fluctuates between 40 to $40 to $60. So you can make the trade within. Like there's no right or wrong because you still get paid dividend. So you just hold it, you buy, hold it, and then you sell when it gets high and you buy when it gets low. So that's Enbridge. TC pipeline. Mm, this stock is pretty similar to Enbridge as well, but um, the difference is the PE is still high, although the stock price came down. Dividend is similar to yeah, the dividend is similar to Enbridge, but PE is higher. Price to earning ratio is higher than Enbridge. and their financials look ugly. Okay, let's look at Suncor. Net profit margin 13%, 20%, 16%. Okay, it's not too bad. Production of synthetic crudes from oil sands. Okay. So any any company that gets oil from the oil sands is the companies that um, companies like Suncor. They benefit when the oil price is high. So when the oil price is low, they lose a lot of money. That's why the Suncor stock prices plummeted in 2020 October, but it recovered back most of the parts um, when the oil prices skyrocketed, and now it's staying the same. So I would say Suncor is mm, more related to the oil price in the market, and their profit margin will increase significantly if the oil prices remain high. Okay. And Suncor has P/E ratio of 8.85, dividend yield 4%. Um, I don't, it's more volatile. The price movement is bigger. It moves like 50% just like that. But I don't see much of growth either, unless you're buying at the bottom. So the correct play for Suncor is if the oil prices drop and you know the profitability of Suncor will not be good, that's when you wait until the stock prices fall. And when the stock prices fall, you wait until you start to make judgments that the oil prices will climb. Like, for example, if there's a war, if there's something that will trigger inflation, whatever that's triggering the oil prices to go higher, that's when you get into Suncor. If I look at the oil prices, it's been up and down, and it's reaching the second peak. So I would assume that the prices would go up a little bit more, but it'll fall. What we know is the war between Russia and Ukraine um, might settle not in the near future, but soon. We don't know when, but soon. The reason why I'm saying soon is because um, there was Zelensky. So I've never seen anything like this before, but it came up a week ago. So Ukraine's Zelensky charting comprehensive plan to end war with Russia. And then it says he plans to end the 28 months conflict. Da, 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 da. So he wants to end the war. Getting tired. Everybody's getting tired. But of course, there are steps to take. It's not gonna be just overnight. So this is updated on June 26th, and as of now, the southern part is this part here under Russian control. This part under Russian control, under Russian control, under Russian control. Yellow part, Donbas region. So, uh, so Russia had been focusing heavily on the southern side. So the stance from Ukraine has been changing. So before he was like, no, there's no deal. We'll continue to fight, da 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 da. But the message is changing. He wants to end the war with Russia. And President, the former President Trump, it says he can settle the war between Russia and Ukraine in one day if elected president again, da 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 da. So Trump has been pushing to end the war, and Joe Biden, mm, I'm not sure. But if the war comes to an end, we'll see a huge price drop on oil, and that would effectively resolve the inflation, and that could put all the pressure that have been on um, the interest rates in the world by, I don't know, at least 30%. If that were to happen, then it's going to lower the oil prices and Suncor stock prices will drop. Will drop. What Joe Biden is doing is he's actually doing very good. He's doing very well for the United States because US has a lot of oil sands and their profitability had gone up because before the oil prices were um, very low, so the oil sand companies were not doing well. But Suncor is doing well. ExxonMobil, Shell, let's look. ExxonMobil, let's look at their stock prices for the last year. Pretty well. Yeah, they've been doing pretty well. See, when the profitability dropped, It dropped, but it recovered because of the high interest rates. Let's look at Shell. Their profitability is also good. Mm, let's see. Same thing, doing very well. But look at that. Before it was dying, and because of the oil sand, these companies are thriving. So some people might say, "Hey, U.S. is burning this, burning that. They're keeping the war going on. Da 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 da. It's bad for the economy, whatever." But Joe Biden is actually reviving the U.S. market and reviving the energy sector that have been dying. So it's bad for us consumers, but it's good for keeping the technology alive and keeping these companies alive. I don't know how you'd see this as a good thing or bad thing. I see it as a necessary evil that it's kind of helping. Um, it's helping them. It's helping the Canadians and it's helping the U.S. side. Let's look at Shopify. Oh, it dropped a lot. It dropped. Yeah, I remember it was like 200 something dollars and dropped to 90. I want to look at the financials. So it's still a growth stock. It's still growing. Shopify is still growing. Became profitable, and then it's consistently beating the market. Okay. Shopify, the market cap is 120 billion. It's still growing, but I think the PE is pretty high. The PE could be negative. Okay, it's just very high. People perceive Shopify to be a growth stock. Forward PE is, I believe, greater than Nvidia. Yeah. So if you look at Nvidia, and you cannot just compare these two companies because what they do is totally different. But at least you can tell that yes, Shopify is a growing company, but their trailing PE and their forward PE. So this is the forward PE means um, w- the expected earning compared to um, what would come next. Okay. If you look at the forward PE, used to be worse. 61, 62, 2023, right? But getting better. Nvidia is better in terms of forward PE, so it's cheaper compared to Shopify, as of what I see here. So I would not touch Shopify. In fact, it'll be more reasonable to say if Shopify has a bad quarter again next time in the next earning, then I would expect Shopify to drop heavily, like drop heavily, heavily, heavily to possibly like 50s, 70s or 50s. Yeah. Like this valuation doesn't make sense. $200? Wow, that's ridiculous. So what's going on with Bitcoin? It's been dropping. So Bitcoin has been dropping. Hmm, okay. Enbridge is knocking on their resistance 3 times now. It looks like it might break though. Either way, Enbridge 7.47 return, TRP 7.36%. Okay, okay, and I'm going to find a similar. So, as far as the energy goes, I don't see any other stocks to invest in for the long term other than Enbridge and TRP for now. Um, I'm going to sue energy dividend stock ETF Canada. BlackRock. Okay, their returns are not even better compared to their dividends, so I'm not gonna touch it. How about this guy? So it came out in the market for $16 on February 9th, Friday, and it earned $1 after paying out all dividends. Let me look at the fact sheet. So it's doing dividends and option premiums. It invests in energy companies. Da, 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 da. But it does not have Enbridge. So they only invest in the actual companies that mine gas or energy or oil directly. This is not what we're looking for. So this one we saw, we want to look at the fund details. Since inception, it's only 3%. But as you can see, when the returns are high, the returns could be very high. Uh, but if you see, if you invested 10,000 in 2014, it lost, wow, almost 80%. It lost 80% in 2020. That's why when it recovered, wow, it went from $2,000 to $10,000. That went up by like 8 times if you were to invest in 2020 into this mutual fund. That's crazy. That's crazy. I will not touch it. I will wait until something similar happen and then I'll look for this ETF, but I'm not getting in there now. So I can't seem to find any dividend paying stocks focusing on the energy sector. So what I'll do is I'll just put this these two individual stocks as a recommendation. Okay. And this is actually one of my favorites, HDIF. So this is, I think it's pretty secure because what they do is they invest in so many different things to a point, I don't know if you can make money, but it's making money. Current yield is 10%. It's been doing pretty well. It invests in pretty much everywhere, like financials, healthcare, utility, energy. So they are mm, they're covering pretty much all the sectors equally. Okay. And it started from $10 in the beginning, 2022. Now it's at $8.28. So it went down by 20% if you bought it from the beginning. But they have dips here and there. And it's paying 10% dividend. So um, I would say because it started from 2022, right now it's 2024. It paid dividend for 2 years. Every year it pays 10%, so that's 20%. So the fund itself is pretty much flat from the beginning. If you compare that from the beginning, it's pretty much flat, but it will have its days. It will have its days. When the economy recovers, I'm pretty sure this one will go up as all the other sectors will revive, other than just the tech sector. So I'm going to put HDIF. That was 10%, 10.27%. Um, so I would actually recommend to put these for your RSP portfolios, HDIF, TRP, Enbridge, HCal, and then what you should do is you should get into a DRIP program where whenever the dividend pays, you should put that back into buying the stocks, like over and over and over, and it will create this compound effect. And in the end, I'm pretty sure your like average annual return will be close to 10% with these kind of yields. Okay, so that's that for today. I need to run somewhere quickly now, so I'm going to share this in the group, and I'll talk to you tomorrow when the market opens back. Okay, thank you. Bye bye.